What's up, ModelFA's David DeCelle here, CEO of ModelFA and your host of the ModelFA podcast. And we are joined here today by Jonathan Foster, who is the president and CEO of Angelus Wealth Management, which is a national wealth management firm serving generationally wealthy families. And before we open up the show, I just want to share a special thank you to Lexi and the other folks over at Street Cred. They are the reason why Jonathan and I are here together today. But with that said, Jonathan, welcome to the show.
Thanks so much, David. Appreciate it. Fun to be here.
Likewise. And you just got back from a little getaway in France, right?
Yeah, so I got my staff teased me that it's the first vacation I've taken in 12 years, and they ordered me not to call them, which of course I got through about 7 days, and then I started to get the shake, so I had to start like emailing her. I didn't call, I emailed though, and I was in France for 2 weeks, and we had great fall weather, so it was really worth it. But now I'm like, so then you come back and everything's all backed up, you got to catch up again. That's typical, but very
Yeah.
well.
I hear that. Well, walk us through. I guess let me start with the end in mind for folks who may not have heard your name before or your firm before. So, Angelus Wealth, you guys are at 2 billion-ish right now, correct? And you've had some quick growth. In 2017, you're at like 250,
Right.
2022, 1.1, and fast forward just a few years later at 2 billion. So that's where you are now. Let's go all the way back. How'd you get started in the industry?
So, my first job in the industry was I was an institutional equity sales trader in New York, and then I ended up working for one of my clients, who was a hedge fund operator back in the day, and turned out I wasn't very good at hedge fund trading. Like we had a trading pool, and it was that really wasn't my expertise. But in the process of that, the boss said to me, John, you should be a stockbroker, which I took as incredible insult at that time. But he really meant as you're good talking to people. So eventually, I took the advice of somebody much smarter than I was, and I somehow got a job at Bear Stearns back in the late 80s. I don't know, still don't know why they hired me because I had no clients, no money, nothing, but I had a little institutional background that helped. And so I really started in the wirehouse space on the private wealth side. And then with the arrogance of youth at the age of about 30 years old, I started my own firm, and eventually learned over time the value of good partnerships. So, but I was in the wirehouse space at Bear Stearns, and then my own little brokerage boutique. And then in the mid 90s, I called a team meeting one day. I was in New York City at that point, and said, I've bought an interest in an RIA, and in 6 months, I'm closing the broker dealer, and I'm never going to do another brokerage ticket in my life. I'm done. And you guys can have all the clients, all the business. They all went, sounds great. None of them are in the business anymore. Right? So it was a good decision, but I was sort of went cold turkey. I didn't think about hybrid or keeping my licenses. I just let all my licenses expire. Went full turkey into the fiduciary RIA space in the mid late 90s, and that's what I've been doing ever since.
And was it Angelus Wealth back then, or I guess help me understand the progression to where you are now?
The first stop was a company called Howard Capital Management, and we built that up over a period of time, and that was sold to E-Trade in 2005. And then I took and Howard still exists today. They bought themselves back after I left. But I sold it to E-Trade and then took a job at E-Trade, sort of doing corp development and thinking through an advice strategy for E-Trade, which was a great experience of sort of running around, getting to meet lots of other RAs, which usually in this business, you are in a little silo and you don't get to talk to a lot of people. But I must have visited 50 other high quality RAs for E-Trade, and I bid on a dozen of them, and we bought three more. And so that was a great experience of getting to meet some of the really top people in the business, so developing friendships with some really terrific, great operators from anywhere from mass affluent to ultra high net worth. And then when I left E Trade, and ended up as the president of Carson Wealth Management in Omaha because I met Ron and we got along really well. And he said, "I like your ideas. Why don't you come to Omaha and be president and be president of my advisory business and my consulting business, and then the customer, excuse me, the employees report to you and you report to me, and let's do some of these ideas about how to build a national brand." So I commuted from LA to Omaha for 2 years, which was not going to be a long-term thing, but I like to think I was some material helping Ron and sort of building the business that he did today. And then the current iteration of my life, which is at Angeles Wealth Management, I got to know Angeles originally because I was a client. So I was invited to sit on the investment board for the City of Hope Hospital, which is a really wonderful cancer research hospital in Pasadena. And we went through an RFP process of hiring a new consultant, and these guys from Angeles Investment Advisors showed up. And so I was a client for 5 years of that business. And what struck me like a lightning bolt was how much better the investment opportunities and ideas came through to the institutional side has made it to retail. So I sat down with the Angeles principals after I decided that the LA to Omaha commute every other week was not a great lifestyle choice, and said, I have this idea. What if we built a wealth management firm where anything that we build and provide for $1 billion institution is available to families at the same terms? I think that'd be kind of cool. And they said, that's great. We don't know how to do it. So if you want to do it, let's go. So I opened Angeles Wealth Management in partnership with them, employee number one of one with no clients. This is after 6 months after I left Carson. And then we started with that principle, and that's like still the elevator speech today, which is anything we build for $1 billion institutions available to families at the same terms. Turns out there's a pretty good market for that. So I'd spent most of my life in sort of mass affluent, and all of a sudden now we're in the ultra net worth business. Like, I don't think I did anything different. It's just the toolkit that we had to work with attracted larger families, more complex families. And I don't know that our business is a better business than mass affluent or high net worth, whatever. There are fantastic people like Ken Fisher out there who built a fantastic business with, average client of 500 to $2 million. Ron Carson built a fantastic business in the mass affluent space. It's just you have to have the right toolbox for the right problem. And so we started with Noam, in 2000, and we took our first client in 2012. And today we've got about, I think it's 110, 120 families, and we just crossed 2 billion of advised assets of AUM. And made offices in Santa Monica, and then I opened an office in New York City and also in Houston. And that's where we are today.
And how many advisors are helping run the RIA?
So we have a total of 7 advisors who are directly client facing, in all 3 locations, and total support staff on the wealth side of about 14. But then the institutional side of the business, I want to touch on a bit, that still exists. So Angeles Investment Advisors, our sister company, is a 25-year-old firm that specializes in endowment and foundation management. That has, I think, about 70 clients and about 45 billion of advised assets, including around 7 billion of what they call true OCIO assets, which is fully discretionary assets. Mm-hmm. So I have a lower body count because we have one investment process, and that investment process really sits on the institutional side because that's their core competency, which is, researching great managers, doing asset allocation strategies, building access to privates, et cetera. So there's all expression that all my staff, I drive them crazy with it, which is I say, I can't dunk a basketball. Don't ask me to dunk a basketball. I'm not tall enough. I can't even palm a ball, right? So I am good enough at investment research to be dangerous. So I get to plug in and work with people that are fantastic at it. So that's sort of what we built. So on the institutional side and the private wealth side, we really have one research and investment management team that's building solutions and opportunities for both families and institutions. And we'll sort of sit together and cross rough and help each other.
So when you helped launch the RIA, in 2012, you said, correct?
As first, well, yeah, first client 2012.
Okay. So
Still a client today, which is great.
that's a good sign. So when you got your first client in 2012, where have the hundred and so families come from that you serve in the RIA? Were you kind of prospecting inside of the institutional business, or was there a different marketing and business development strategy? Like, how did you start in terms of acquiring clients?
So there's one really great advantage of doing a startup, which is that you get to do things the right way from the beginning. Because it's like in my tenure as CEO of Howard Capital, there was a Hal Howard who started that business. For Carson, there was a Ron Carson. So the project of re-engineering, of turning good to great, is really hard because you have successful people like Hal or Ron who had built the life and the business success of doing things a certain way, and if you want to do them better, it's tough. And so when you start from scratch, you can use all the things that you've learned from everywhere else, and you can do it right from the beginning. So my biggest issue that I thought about a lot was, so after spending time at E-Trade and dealing with a lot of public company bureaucracy, E-Trade is now sold to Morgan Stanley, but like so much channel conflict, and those, your advisor listening to this, anybody who works in a big wirehouse or something, they understand channel conflict. How do you get different people to work together for the success of the business and the clients? So, and the first one is the cross sell. So I thought there's a great opportunity for us to work together collaboratively between institutional and private wealth, where, we would help identify true institutional clients in either money management, and they would help us identify wealthy families. But I think they're identified really with three reasons why cross sell doesn't work. First one is, I don't know who you are and I don't trust you. So what I did was, when I was employee number one and people didn't know who I was, I took the office next to the kitchen and just talked to everybody in the organization. At that point, there were 40 people on the institutional side, and just getting to know them so they know that I wasn't some weirdo and didn't have two heads and actually knew what I was talking about. The second limit channel conflict hurdle is, what's in it for me, right? And why would I go out on a limb and refer something to you? And so what are the economics? So economics could be you share fees or whatever it might be, or you just get along great. But what's in it for them is that the Angeles investment advisor, the institutional shop, right from day one, was a shareholder of the wealth management business. We're separate entities, but they're also shareholders. So they have, and what's in it for me? They're a shareholder like I am. And the third one, that's actually the most important one, which I think people that don't know our business are shocked by this, is the embarrassment factor. Let's say, David, you're one of our very smart institutional consultants that's helping a nonprofit, and if some board member comes up to you and says, "Love what you're doing for the hospital. Could you help me with my family?" Because who sits on investment boards of nonprofits? Rich people who have lots of their own money. So what the issue there is, so if you're that investment consultant and you refer one of your board members, and I blow up the account, I probably blew you up too. So my sort of theory on that is, the mitigating factor for that is, well, if the portfolio gets blown up, you should look in the mirror, because we build it's a centralized investment process, and your fingerprints are all over it. So I'm not a weirdo. I'm not a stranger. Two, the economics of shared ownership. And three is a consolidated investment process where, that person on the institutional side could just pop in on a phone call and talk about the portfolio. And those characteristics exist in that client's portfolio because we have a centralized process. So it doesn't matter if you're an institution or a private family inside the Angeles complex now, right? You are overweight U.S. large cap growth. You have an average duration in your fixed income portfolio of approximately 5 years, because there's certain things that we can actually dial in on and um, and because they got to get the themes right. So those are the three things that were the sort of the original principles. And usually that doesn't happen when you come into the middle of or the middle of the life of an organization, is there's so many legacy issues you have to work through, and you get a lot of pushback from people that where it's been successful for them.
Well, the ego is that last thing that you just said. You put it as pushback, and it's usually pushback because of ego. It's like, hey, I've gotten this far, but the legacy issues that you allude to, it's interesting. Like when someone first starts that may not have been in a position that you were, or have had an opportunity to be a part of a sister company that you were, they find themselves making whatever promises they need to make to that person to bring revenue in the door to survive. And then what ends up happening is they fast forward 5, 10, 15 years, and they can't keep track of the plethora of promises that they've made. And it creates an issue when it comes time to scale. Whereas if all of your stuff from an investment standpoint, as the example we've talked about, is centralized, it's a machine. You can just scale from there because you're making the same promises, generally speaking, to different people. Is that a fair synopsis?
Yeah, but and I think on the good to great thing, which is a term been used a lot, but like imagine sitting with Ron Carson and telling him there's a better way to do something. I
Hmm.
mean, the guy is wildly successful, one of the most successful and well-known people, but business builders in the mass affluent space. But there's always ways to get better. And so, I'm a professional strategist, business operator, and there's a lot of stuff I'm not that good at, but the one thing I'm really good at is thinking through strategy, trying to build strategy around putting the right people in place. So that's hard. So, but when you start with just like sit from scratch, you can say, okay, now no one now someone can call my bluff, and I'm just going to do it this way. So yeah, and some of the things you described are so true, which is the scaling. So I mean, it's hysterical, and everybody calls me Doctor No because I basically say no to almost everything the client asks for because it doesn't help them and they don't remember what they asked for 5 years ago. I'd like my statement to read back to front and I want it to be in blue ink, not black ink. And can you send 3 copies to all my kids and one to my CPA? And the CPA is never going to open it. And you just say no. Here's our portal. And I don't think I ever lost a client by saying no to requests that don't make sense. Obviously, we bend over backwards for clients and things that are really important, like, you know, and anybody in our business knows, like, we always send the 1099s, the tax documents way on time to all our clients, and they never find them and they pretend and they think we didn't send them to them. We're scrambling right before extension time to get them the forms again. So that you have to do. But the stuff that's not scalable or silly, just like we don't send appraisals, hard copy appraisals to anybody. The people have asked, we just say no. Sorry, we just it's not it's not
It's
our it's not.
almost it's almost 2025. No.
But I'll tell you, there are a lot of my colleagues out there in other businesses that still have a measure of their clients that they still like bind hard copies and send to them. I still ask for hard copies of my bank statements. Now, I like to flip through paper, but then I feel bad about killing a lot of trees. But someone should say no to me. Right?
And
So,
and you'd probably deal with it if they said no. You'd be like, okay, it's time to digitize this aspect of my life.
but I think that advisors, first of all, there's a don't rock the boat thing. It's like I'm a rock the boat person, right? I mean, the whole point is like you don't be afraid to wake your clients up because they might fire you, because then you don't really have a good relationship anyway. Have an open, honest dialogue with them and do things that are scalable for yourself and good for them, and don't waste time on things that don't matter. And if I don't really think you're going to lose people along the way. It really doesn't. I've never really seen that happen. So that's the whole Dr. No thing.
So to tee up my next question, I have a question. A lot of folks will say high net worth or ultra high net worth. And although it sounds similar, people have vastly different definitions of what that actually means. So to tee up my next question, what's your definition of ultra high net worth families that you work with?
So yeah, right, it's a fuzzy line, a rubber ruler. But generally speaking, it's going to be ultra high net worth is going to be clients that have 30 million or more of investable assets. So, and I think that, for the time in E-Trade of getting to go around and talk to dozens and dozens of great business operators and seeing different models, you just you have to find your spot, and so, or your spot finds us. So I spent most of my life in the $1 to $5 million market, and now our target client is a $10 to $100 million family. I don't know that I did anything different. I just happen to have a platform that attracts those people. They see that difference. And the other thing I think is that if you look yourself in the mirror about who you should be serving, everybody wants to have bigger clients, but you can't serve clients with whom you're uncomfortable hanging out with. So if a conversation with ultra high net worth client is, should I get a NetJets account, or should I just keep flying first class? If that makes you uncomfortable, which is fine, but that's not your market, right? I mean, I did an interview for, when the inflation was skyrocketing. I did some interview. I can't remember what it was, and the interviewer said, "So John, so how are your clients reacting to higher interest rates and inflation?" And I said, "They're not." So what do you mean? So no one's canceling the vacation to Tuscany this summer, right? And matter of fact, higher interest rates is actually good for this group because they always have cash balances, and now instead of getting paid zero, they're making 5%. They feel, or now it's 4%. They feel like it's found money. It's a different perspective, different world, and so you have to so our spot is, like, I would call it to be, family office light. Not really big enough or rich enough to be in a single family office. A single family office, I think it's 2 billion and up. And a multifamily office is probably 250 million and up is the right spot. So, but we're in that group that they're used to flying first class, but very often their portfolio is still in coach. So that's part of so it's sort of the 10 to $100 million client market.
Gotcha. And so my question, the reason why I asked that to start, you had made mention that for most of your career, you spent time in the $1 to $5 million space, right? Um, One of the things that I get asked a lot from advisors is, hey, how should my client experience look? So not client service, not your service model, not your sales process, not your review cycle, but the experience, the thing that gets them to stay above and beyond your core competency. I'm curious to know, in that 10 to $100 million space, what does that experience look like, that they can come to expect in working with a firm like yours?
Right. Well, so the first thing I would say is to, is what does the world look like out there? We just had we had an election where, people that are feeling disenfranchised, working class people, raised their hand and voted for something different. We're in a country where half of America doesn't have $500 for an emergency, and most of the rest of the country is dealing with that burning question, which is, will I run out of money before I die? Which is a horrible feeling. My group is, most of them have cleared that issue. They're no longer worrying about running out of money. And for a lot of them who are self-made people, they get over that, and then it's like, okay, now what's my purpose? So once you have clients that are not going to run out of money, they don't freak out as much when the market's volatile, or even when interest rates go up. They're thinking about other problems, like, my kids are screwed up, or how long am I going to work, and getting divorced, or how do I minimize my estate tax bill, things like that. So it's amazing how little of our conversation with clients has to do about the performance of their portfolio. I mean, it's maybe 5% of a conversation. Now, I think part of it is, I think we're pretty good at it. And I think that we have the credibility of, the institutional gravitas of our sister company helps build everything for us. But, I mean, it's only about money when you don't have enough. Right. And then it's about other stuff. So it's like, So now you've built enough money by working hard and you're not going to run out. And so, what's it all about? Is your goal now to, to be the richest person in the graveyard? Is it to bounce the check to the undertaker, or is it to support the people you love and the things and the causes you love and leave a legacy? So a lot of our conversation with these people is around legacy. Now, you also run into a lot of really nasty wealthy people, and they just can't come. So I think client selection is super important. Just because you're rich doesn't mean you get to be a client. If you're not a nice person, you use up a lot of bandwidth, you're nasty to the staff, don't take them. It's just not worth it. There's so many nice people out there. And then you build a good environment for your staff as well. It's like just because you're rich doesn't mean you get to treat people badly. So
Hmm.
a lot of our conversation is around things that have absolutely nothing to do with their portfolio. Like after the election, I got one phone call. One phone call was, I feel like the market just bounced. Maybe we should we lighten up? And I talked to my colleague Chloe, who runs the client with me, and I said, let's do the analysis for this client if they sold 10% of their equity position. And I'll tell you what's going to happen once we show what the tax costs are from because the answer will be no, I'll wait. It's exactly what happened. But it's to be responsive.
Hmm.
But most of the dialogue I had with that client is about their anxiety about what might change in the world over the next 4 years. Not about money because they're not going to run out.
So is your if I'm hearing it correctly, from an experience standpoint, they're not necessarily experiencing the nitty-gritty math behind all the work that you do. They're kind of past that. Obviously, you guys will have that conversation if needed, but you're more so focused on the personal aspect, the legacy aspect, the giving aspect around the things that are going on in their life. Is that a fair synopsis?
Yeah, I mean, I think there's a litmus test of, you know, are you good or do you suck at managing money? Right? If you clear the hurdle where you're good, I don't know that I've ever recall having a conversation with the client in the space where they said, my portfolio is up 8%, but the benchmark is up 10. Like, what benchmark? The only benchmark is your benchmark because right
Hmm.
now, I mean, the embedded gains in our portfolios from years of a great stock market are so high that I say to the clients, when you showed up and you brought $20 million of cash, it was really fun. And I felt like I was piloting a speedboat. And now, 10 years later, I feel like I'm pushing a barge down a narrow river because of the tax consequences. So, like, especially now, it's like November, it's almost the end of the year. So we're definitely overweight stocks in general. And we should, but if we rebalance, all I know for sure is if I rebalance that everybody's going to pay tax.
Hmm.
I don't know if that was a good decision to rebalance. Maybe continuing to be overweight growth stocks is still a good thing, right? So tax is the one thing you can't get back. So the experience is interesting because I think your relative performance becomes less and less important as more appreciation. Like I wish that the standard reporting for clients was not annualized return IRR. I wish it was cumulative. Now you have a client for a long time, their portfolio is up a cumulative 100%. Market goes down 20, they know they're still up 80.
Hmm.
So from being less, from being irrational. So our dialogue with the client experience is yes, every client gets a quarterly report. We don't meet with everybody every quarter. It depends on what's right for that relationship. If I get a call from a client, believe me, all their data is up in case they ask a question. Um, but then once they realize we're on top of that and we're still that trusted advisor for the family, then we're discussing the real reason they called.
What's your involvement with the next generation? So they have
Right.
kids maybe in their teens or college, or even adult kids in their 20s to 50s, depending on how old the client is, and perhaps they haven't yet built that level of wealth for themselves yet, but they're going to
Right.
inherit it likely. How do you engage those folks early on so you're not fighting to retain the assets later on?
Right. Well, so first of all is looking in the mirror and seeing who am I, right? I'm not the same person that I was 20 years ago because I think know a lot more than I did 20 years ago, but I don't have the same credibility with, a 25-year-old that I had. There's some who still want like another dad, but most want to talk to somebody who's a little closer to their age and I totally get it. So what I've done is hired some really fantastic professionals in their late 30s, early 40s, because they can go either way, right? They can talk to,
Right.
I don't have to talk to the old people and also to talk to young people. So I think that what we assignments we've got a lot from mom and dad is to teach some concepts of financial responsibility to the kids. And sometimes the kids know nothing, right? They become completely in the dark. Sometimes they know nothing, but they know they're rich because, they spent the summer in the south of France for 3 weeks, right? So it's not like they know, right?
Right.
Right. They know dad just bought a Ferrari, right? But but they don't understand things. So part of it is like that grade of late 30s, early 40s, and it can even be younger one people too. But I tell everybody your sweet spot, you don't hit your sweet spot till about 35. Then 35 to 55, you can kill it because you know a lot, you can go either direction. I think for the younger people a lot, it's first of all, if it's a blessing for mom and dad to work with them, it's about education and also some help them think of how planning works, right? And then whether they're been brought over the wall and what their true wealth is or not, it depends on how you teach them. We have 25-year-old clients who are kids of clients who are fabulously wealthy and they're well aware and they spend like a prince, and others that want to live within their means. It is, but education is important because if you don't talk to them, you're going to lose them, right? But an even bigger thing, David, I think is husband and wife. And so many advisors in our space when they're talking to a couple or they only talk to the husband, who's usually the wealth creator, and historically, but the spouse is sitting there saying, "This guy is so fired because he won't even look me in the eye." And there's going to be $70 trillion of wealth transfer coming up to the from my generation to the next or the great generation, which is one step older. But before it goes to the next generation, it's all going to women because women are going to outlive all the men. And so, the majority of all wealth in America within 10 years is going to be controlled by women. So you better know how to talk to women. You better hire women. And we have a lot of them. And so that's another important communication thing is make sure you talk to both spouses and not who you think is a decision maker because you could be wrong and you're definitely going to be wrong later because I mean, I saw a stat like Americans over 85 years old are 82% women.
Wow.
Right?
Very
7 years more life expectancy.
well, it's
One of my
interesting because you hear the 70 trillion, will be transferred, but it's actually going to be transferred twice over presumably a 10-year period, right? Because it's going to go to the surviving spouse, and then it's not like they're going to live, generally speaking, for another 20 years, probably another 7 to 12, depending on the age discrepancy, and then it goes to the
Yep,
kids from there. So it's going to be like boom, boom.
double whammy. Right? The first one, there's no tax, but most surviving spouses fire fire their advisor. So that I think we're good on that because we're really good at thinking about that. Also because we focus on the people, as much as we do the portfolio because people hire people, and and when you get to this alternate workspace, like they're really not trying to grind out the last nickel, but
Mhm.
they're trying to work with people that they can bring over the wall of trust.
One of the topics that I want to wrap up with that will probably take us some time to go through because I will probably ask a lot of questions, but we had talked about how you've aligned the interests of the clients and the firm
Right.
with, if I'm not mistaken, the alternatives and private equity offerings that you guys have. And frankly, this was, I don't know if other firms are doing it or not, but this is the first time I've heard of it. And I just thought it was so interesting when we first connected. I was like, that makes all the sense in the world. And frankly, everyone wins, on the upside. So start off by, I like saying, like, explain it to us like we're five, and then, let's get into the details.
Well, the first thing I'd start with is, how do you retain really good talent in your organization? Now, our headquarters is in California, as you know, like it's an incredibly employee friendly state, and I'm an incredibly employee friendly person. So, how do I get my great advisors to stay? And my strategy is all carrot, no stick. Like basically, I don't really have like non-competes and non-renders for people. If they want to leave, let me know you want to leave. I'll help you leave and figure out what clients really want to work with you. And you should be here because you want to be here. If you're unhappy, you shouldn't stay. I want you to be successful. We haven't really had, we haven't had any major attrition of people that leave. And part of that is you're trying to think about, I have two sets of clients here. I run the business. I have two sets of clients. I have the end client and I have my professionals that work for me. So all the professionals are Gen 2 at this point. Like Gen 1 equity is gone. Like I got it. I got it.
Mhm.
The old folks have it. So Gen 2 issues are different. If you come to work for me as an advisor, David, and so first of all, um, everybody in this business thinks the way to get your attention is once you're good enough to be an equity owner, you need to buy stock at the fair price, and if you don't have money, we'll lend it to you. Why the heck would you want to leverage your family's life? You probably got kids, you got to pay for school and and dental work and everything else, and to own equity in business that you don't control. It's not very thrilling. It just puts you in stress. I don't want my advisor team to feel stressed. My job is to de-stress their life, think about their success. So that segues into how advisors get paid. So our advisor group, most of them are on the grid, and so they get paid for clients that they, and there's two functions. There's hunting and farming, for lack of better terms. So
Mhm.
you can go hunt for a client, and you can also service that client, or you can share with other people where it might be. And then also the firm itself is a tremendous generator of leads, which we hand out. So eventually, an advisor whose season will have 30 or maybe 40% of the clients that they're servicing are ones that got handed to them by the firm. And then they're big, right? So someone's trying to get you on the tape. We did something really radical, which I think you're referring to, is that so we've been designing or researching, designing, and creating opportunities for both institutions and families to invest in alternatives for since we started. And on the institutional side, that's like table stakes. So that's going back 25 years when the institutional business started. And we always package and create a commingled fund so that when we find a great investment opportunity, we're only looking for one slot, not 80 slots. And so there's some efficiency around that. And so private equity, private credit, private real estate. We don't do hedge funds anymore because we just don't think there's any return there. But what's happened is that the talent costs of doing that really well have gone up and up because people of high quality in that side and research and structuring and investment officers that side are really high demand. And traditionally, what we've done is if a private wealth client has 80% of their assets in public securities and 20% in alts, they pay the same. It's 75 basis points, 50, whatever it is, for whether they're buying money market or they're buying private equity. It doesn't matter. So the radical idea we came up with in early 2022 is went back to clients and said, we're going to change the way we're going to charge you on when you do alts. So now when we call your capital for an alternative investment, each dollar, meaning we call a dollar, we stop charging a management fee on that money. And instead we take the success fee if we're successful. So that may mean that over the next 3, 5, 7, 10, 12 years, however long it takes, we will make nothing. Now, but it's kind of like a negative management fee because we're still paying the cost of doing all the due diligence of opportunities and structuring, et cetera. It's just that we've decided is that we're asking you to be in something that's more esoteric, it's more long term, and but we think we're really good at it, and we're willing to put our money where our mouth is. So, and so you think of from the client perspective, I say to them, okay, so every time we call your capital for a private equity investment, we don't make any, we lose money. So we only make money if it's a really good idea. So everybody in the firm is aligned with you, which is just let's not do bad deals. Right? Like it's not like it's a 2 and 20 fund where we have to call your money to justify our 2%. Every time we call your capital, our revenues go down. So what happened was we didn't know how the clients would react to this, and it's been it really got tremendously good reception, far above whatever we expected. And now only way we do alts is in that format, where it's a 0% management fee and it's a performance fee, sometimes above a hurdle, sometimes for $1, depending on what the solution is. And what we found too, which is interesting, is that I mean, it's really helped in new business development. So this year, 2024, on the private wealth side, our revenues will be up 50%. And so I thought, like, why is that happening? Like, why are we opening so much new business? And I realized, okay, so your typical wealthy family, when they're always talking to them, when they're thinking about who to hire, they're going to talk to us, they're going to talk to a bunch of other firms, and we all sound alike. Blah, 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 long-term, steward of capital, tax. It's a buzz after a while. But we're saying something different. And so, and it's interesting, if in business school, they used to teach the case of marketing of Nike. In marketing of Nike, they said that 95% of the decision to buy a pair of sneakers is based on how good that pair of sneakers is for the sport for which it's designed. But the buyer never uses it for that sport. They're never going to play competitive basketball, right? But the credibility of how good you are at that is what makes the sale. So for us, it's been a differentiator around opening new ultra net worth business because it's different, and we're willing to put our money where our mouth is. The other thing we've done, when I started off with talking about the all carrot, no stick of talent. So if you're my advisor and you have a client and you're getting paid a percentage of the revenues, which if you're a sales oriented person, you like that because you believe in yourself and you're okay making less if you have a bad year but you want to be rewarded properly and not have to wait for John to decide what your discretionary bonus is, right? So when one of your clients does privates, your revenues go down too. Your income goes down. So what do? You are actually written in as a partner of the private equity GP, pro rata to your contribution. So not only you're in the private wealth business, you're a partner in a private equity business. So talk about a long tail opportunity for an advisor, because there again, you're completely aligned. And tell that to the client. Say, I personally lose money when you do this, but I actually share in your success. So I'm your advocate because I want you to do really well because I'll do a lot better too. And if we do a bad job for you, I can look you in the eye and said, we made nothing. So it's about that alignment. So, but if you think of it, someone tries to recruit one of my people and they have a 10-year tail in private equity. Nobody quits a private equity firm before the harvest period, unless the boss is so terrible they can't hang out anymore, right? Who would leave?
So maybe it's my own naivete, but I haven't come across that model in this industry in the RIA space. Have you? Is this something that you guys came up with, or am I just naive and having not come across it yet?
So the cool part about being employee owned and you're not being owned by private equity or bank or somebody else, big daddy looking at you, because you can do what you want with your own money. So what I think about it is I could take $1 of profit and pay 50, 55 cents in tax, or I could reinvest it in something interesting in the business that I think has long-term value creation. So this has cost us a lot of money. It's a lot of foregone revenues. It's a lot of investment in talent costs because the whole thing is don't do bad deals, right? Um, and uh, you know, and I tell everybody what we're doing. I tell competitors what we're doing. I think they should all try and do it. Take a shot at it. First of all, we have a 25-year history on the institutional side of building the infrastructure to research. And so part of doing great private investing is knowing the right people and being in the loop and being a consistent player. And so, but then hiring those people. So it's a really long investment timeline. And, I'm excited about what we do. Obviously, I can't talk about numbers and things like that because we're all, they're all private funds, but I think the structure is really interesting. So I think when I talk to other people about doing this, I'd say go for it. I think it's a really good thing for the clients, but it's a really expensive thing to do, especially if you haven't built the infrastructure. So I think every advisory firm now realizes that they have to have some type of alt solution. And there's lots of cool stuff being built now, but I'm not so sure that an investment, well, so if someone comes to me and says, I want you to invest in my new business I'm starting up, and I can't give you any money for 10 years, but I hope it's going to work out. I think I have the right to, I will probably try to underwrite that to expected return that's, many multiples of the public market because of the risks I'm taking. And the seller basically agrees with me. Now we're just negotiating the terms. So I don't know when you take alts and then try to make them so they're, monthly, daily, liquid, perpetual, whatever. I don't know how much slippage there is in return in order to create that type of liquidity because these things aren't supposed to be liquid. It's supposed to be for like we only have QPs in, so qualified purchasers. So that's 5 million of investable net worth as an individual, or I think it's 25 million for an institution. So no one below that can even go into it because and we still go through a long process to make sure that they understand the illiquid nature of that. And I think that you have the right to expect that your return should be better because you're willing to do the lockup. But if you don't do your process right, you could be stuck, you could be in a bad investment for a really long period of time, and that's a really bad result.
So interesting. And I can see how, you know, rich people hang out with rich people. So when they're sitting around the dinner table, sitting around the fire, sitting around, doing whatever, and something like this comes up, and usually it's, the standard is, a 2 and 20 style model for people that have that level of wealth. And when they hear the setup that you guys have, I can see why new clients and money is coming in hand over fist because it's different, it's intriguing, it's fresh, it's new, and you know it's aligned.
It's worth the dialogue, right? It's a good opener, and on many of the things we do, there are sub manager fees because we're a endowment style advisor, but it's just but the person who's pulling the trigger for you we think that's an alignment. From a compliance standpoint, this is definitely a much beefier disclosure that you need to make because of the conflict, and the conflict is, and you can't even say we may make more money in this format. The conflict is our advice may not be impartial because we will make more money, right? You can't even,
Hmm.
but when but what's described as a conflict, I think, is also a feature. Like I would give money to myself for this format.
Hmm.
I like this format. I don't mind paying well for success. I don't like paying for failure. So but from a new business standpoint, I think it is a differentiator. And I've talked to people that run, friends that run major firms, multi, 10, 20, $50 billion firms, and they give me the blank stare like, are you kidding? Like, how would we do that?
Well, and to
You
your point,
just
you had that you just wrapped that piece up well, where you said, it's certainly a conversation starter. It's worth a dialogue.
Well, and as the operator, as the equity owner, you have to be willing to take the hit.
Hmm.
It's expensive. Like
Well, and it's expensive, but it's expensive, and the cost is dollars, yes, but with patience, it's not expensive. It's an investment.
right. And so and look, all of us, your audience is advisors, and everybody knows there's like a crazy market, in the PE market of private equity firms running around. Somehow, for some reason, they think that our business is like a software business now, right? It's so valuable, and the general belief is that traditional private wealth cash flow is the highest valued multiple in the business, and performance fee revenues is worth a third. But if your potential for performance revenues is quadruple, I take door B. Further, if that structure helps you open more clients and using that Nike formula, so and maybe that client who signs up with me, maybe the targets when they talk to their advisors only going to be 10% in alts, but it might be 95% of their buying decision because they feel there's an alignment. So we'll see. It's still kind of young, right? We started this in 2022 is when we first, and we didn't know people would throw plates at us, but we got very good reception for both the
Well,
private client.
hopefully that stays a figurative comment, not a literal comment.
A lot of, there's no question here that if we screw up, it's extremely visible here, right? But the good part is if we have a if we have performance which is bad, I'm knocking on wood that won't happen. At least I can look at clients and I say, well, we suffer too. We're
Mhm.
we were confident and we were on your side of the table, and it didn't work out for you and it didn't work out for us. It's that it's that old joke this is from many years ago. It said, "What does a broker get for a bad idea?" And the answer is a commission,
Yep.
right? So, so it's like the opposite of that, but it's different, and it's I think a little gutsy, and I like it.
I love it. I think this has been a wonderful conversation. It's cool to see, I have a client who he tends to deal for a while. He had dealt in the um like $500,000 to $1.5 million space. He's now gotten into the $2 to $5 million space, and he just recently received a referral that's $50 million. And he's starting to see that, wow, the work isn't, you know, 5 times or 10 times as
Less,
much, you know,
less.
it's less. And it's cool to see that you can work with 100 families, ranging from 10 million to 100 million in assets. And it's kind of the same as working with families that have 1 million, 2 million bucks.
Right, that's right. So I think that for everybody who's an advisor is also a business operator, right? So it's good to run some metrics on your business. I just did it on ours. So I looked at the top 5 families, top 10, top 25, top 50, 100, et cetera. And I discovered that um, the, the 96% of our assets were in the top like 75 families. But I'll bet you that more than half the work is in the next group.
Hmm.
I think that's, and I'm not, and I think that's because they have, like, if you're still worried about outliving your money, you're nervous. I mean, I get it. I get it. I mean, it's like the market goes down, it has a crash, goes down 5% in a month, and you're worrying about, oh my God, I got bills to pay, and am I gonna have to move in with my kids? So you're gonna be jumpier, you need more love and more attention, and there's more work to do. So, but I think you have to pick your spot. I mean, Rick Edelman's business is so awesome. Rick's an old friend of mine, and his average client size, I think, was under $500,000. He did a really, really good job for those people, right? Because they need full planning and they need some preparation and need to make some decisions early and stick to them. And I think that's great. That's great. It's just not the business that we're in, but it's still, but Rick also was wildly successful as he figured out his model.
Hmm.
So you figure out as an advisor, figure out where you're comfortable. So don't try to dunk a basketball if you can't. And then build a really good model around helping those people. It doesn't matter if you're in mass affluent or ultra net worth. I mean, some of the worst run businesses I've seen are the ones with the biggest clients. I had some guys come to visit me who have an MFO, multifamily office, and they came to me for advice, and they have like 3 families, and they were describing the agony that's their daily life, and they're saying they want to from 3 families to 10. So I said, oh, so you want me to try to help you figure out how to make your life suck worse when you get bigger?
Over 3 times worse.
Right, it's going to get worse because your service model is out of control. Yeah. So, but there are other people that have MFOs that have a great business. They figure out how to do it. But those MFO families or single family office, they know how to get their value for that. Like I don't really want to be asked to pick up somebody's dry cleaning or bail a little
Hmm.
job, right? It's anything to do with money investing and wealth transfer tax, like to be point person on. But there's some stuff I don't want. I don't want to pay your bills. Don't want to do it. But that's just me. But there are other people that have models that are great at that. You got to
Hmm.
find your spot.
I agree. Well, Jonathan, this has been great. Before we do wrap up, one of the things that we always end with, and for those of you who are listening to this for the first time, I ask all of our guests a book that's had an impact on them, and oftentimes I've at least heard of the book. I've read the book, and Jonathan, you have me stumped here. I had to Google this beforehand. You had chosen The Extraordinary Popular Delusions in the Madness of Crowds. And if I'm looking at this correctly, it was written in 1841. Is that correct? Why the
No.
heck did you pick this book?
Well, I'm fascinated with Ponzi schemes, and this book is you only have to read like the first 100 pages because it runs
Hmm.
through Ponzi schemes through time, and it starts with the tulip mania of Holland. That could have, I mean, you read that and if you just took out the word tulip bulbs and you put in like leverage housing of of 0809,
Hmm.
maybe it's Bitcoin of today. I don't know yet, but it's or it's Bernie Madoff, back in the crash days. It all sounds the same, and it's just like what I, but what amazing to me is the guy McKay who wrote this book wrote that you know 200 years ago, and it's the same thing over and over. It's like greed about things you don't understand, and it runs through the tulip mania Hollow. And I think at the peak, somebody traded one tulip bulb for their farm, right? you know, and it's like, you know, it reminds me of the stories you hear back after the housing crisis, where someone remembers a conversation that they had with a cab driver who says that he owns 9 condos, right? All levered and secured against each other. It's just the one thing we learn in this business is I don't I'm get rich quick, it just doesn't work. When I talk to, we have a lot of first generation wealth creators here, and the first conversation we'll have with them is, most great wealth in this country, other than inherited wealth, is by somebody making one big concentrated bet and being right. Our jobs do the exact opposite, right? Our jobs do all the things that you don't like, which is our job is to keep you rich, not make you rich. So you built a business because you invented something, you worked like a dog, and now you built all this money. Our job is to keep you that way. And so a little bit of the whole scheme thing is everybody trying to make things, everybody believing in magic.
Hmm.
I if I don't understand it, I pass. I just don't like.
Well, you don't need, there's plenty of things to understand that can get you in the heading in the right direction. You don't have to take that risk. If you, some people are addicted to that risk, to a grave fault, but it's like there's plenty of other historical and predictable places in which you can place your dollars
Yeah, well,
where you're going to be just fine.
what was it, Einstein who said the most powerful force in the universe is the compounding of money? Right?
Hmm.
So my chief investment officer, Michael Rosen, showed me did a slide presentation. He showed that a dollar invested in the U.S. stock market 200 years ago and reinvested, and the taxes paid on the outside is worth $17 million then. So we have families that had money 200 years ago. They've clearly been bad investors because they're not trillionaires.
Hmm.
Compounding money, if you let it work, if you believe in capitalism, which I do, I don't care who's president. Earnings power is what does it. That's what moves markets. So as long as we have an environment for capitalism, it's great. That's why people that run businesses like like a split Congress in the White House. Because at least things don't change. You know what the rules are for a long period of time.
Hmm.
Because and we deploy capital at a greater than the cost of capital, and you can do that over and over and let that compound. And if you can compound that tax free, it can be a really, really big number. But it's hard when you're young and ambitious and
Hungry. Yeah.
hungry in a hurry. It's just like it's hard to think that someday you'll be 60.
I get that. I'm in the midst of that right now where it's like, all right, just trust the process, and slowly but surely things have been adding up and adding up and adding up. But um we
Yep.
appreciate you joining today. If I'm listening to this and I want to follow along and kind of keep tabs on you, understand what you're doing, where do you want to send me? Where's the best place to stay in touch?
Well, I am a occasional poster on LinkedIn under Jonathan Foster and Angeles Wealth Management. Our our website, which is the same website for both our institutional and private wealth side, is angelesinvestments.com. And we do a lot of posting on there. There's a lot of interesting content. Micah Rosen, our CEO, is a genius. I really love. He does the most interesting quarterly letters because it's not just about market; it's about history. So everything is a history lesson with market stuff in the middle. It's really they're very cool, and you can read them. Ones that are 3 years, 4 years old, they're still fascinating. So and so we're constantly putting content in there, and I think that for everybody, just read everything, right? Just listen to everything and keep yourself educated on top of it, and then a lot of times read everything and do nothing different.
That's the
Just
tricky thing. I had to
let the
coach people. They read a book and they're like, "We got to change all this," and then they read another book and they're like, "We got to go this way now." It's like, whoa, whoa, whoa. Take an idea, if that, and
right
implement it. So,
or an absence of a good idea on the market.
there you go.
Right.
Well,
Thank you.
Jonathan, I appreciate your time. For everyone listening, thank you for joining today, and I will be in touch with you soon. Jonathan, take care. Thanks for joining.
Bye. Thanks.